annual earnings presentation. I've never seen this room so full. Today it's obviously a good opportunity to meet everyone. Welcome to, oh, is that because we now have high yields? So we have credit analysts also. How many credit analysts? Can you raise your hands? Welcome. For the equity analysts, they know us very well. We've been here many times. The credit analysts, I think this is the first time we're meeting all of you. Welcome. So 2012, we had a phenomenal year. I think we've announced the transition to the market a few months ago. And I think that today, when we announce the result, you will see that the result is so strong that it's really supporting our decision of making the transition. And I'm here to announce happily that the transition is working. Because of the Galaxy SOHO's completion in time, and also the Century Plaza, both projects, one in Shanghai, one in Beijing, we're able to produce very solid earnings plus a strong cash position. We now are holding 1.7 million square meter investment properties, and for this year, 2013, we believe this is still a year when asset price is relatively inexpensive. This is still a year of making acquisition. Then the very last, I will mention that today, if you look at the share price today, it's still SOHO China is still trading at close to 60% discount to NAV. This is obviously due to the early stage of our transition, and as we continue to execute our plan, and hopefully this discount would get reduced. Now, because of the Galaxy SOHO completion and also because of Century Plaza, we managed to report a fantastic year with a turnover growth of 169% to 15.3 billion. And then a net profit growth of 172% to a net profit of 10.58 billion, of which, of course, a large part of it is the revaluation gain, which reflects our current business model, which is very much holding the assets, holding the properties, and still a chunk of it, over 30%, comes from our core earnings of 3.3 billion core earnings. Last time when I was here announcing the transition, many of you were worried about whether our gearing ratio would go through the roof. And now that you don't focus on pre-sale, where would you still get that cash to come to continue to support your business? Now, I'm very pleased to announce that as of the end of last year, our cash position is 22 billion yuan, and the net gearing ratio is only 2.6%. We are one of the lowest geared companies among our peer group, and of course, you can see that this is not a year-end number. We put this is an interim net gearing ratio among the peers. You can see that SOHO is by far the lowest at 20%. Today, at the end of the year, that 20% went down to even lower at 2.6%. And the cost of funding, of course, is also much lower than our peers. So the board has approved that with such a strong balance sheet and with such a strong earnings, we will pay 13 cents per share as the year-end dividend, which for the whole year together is 25 cents per share. And it represents an average dividend yield of 5.5% for the past 3 years. When we announced the transition, again, our focus shifted a little bit. Before, our focus on financing really came from the self-financing from pre-sale of our properties. But now that we don't pre-sell our properties, we'll be holding our properties, so we become active in the capital market, raising funds. And a great opportunity came towards the end of last year, where we saw the high-yield market open. So we went into the market very quickly, and I think it was a phenomenal deal. We raised $1 billion high yield, of which 600 million was a 5 years note, and then 400 million is a 10 years note. I think that we had the highest corporate rating for the non-SOE developers. Moody's gave us A1, and Standard & Poor's gave us a BB+. So that was very supportive. So we're able to price it at a coupon of 5 3/4 for the 5 years high yield, and then 7.125 for the 10 years. This page really shows us how we're moving from selling everything. For instance, back in 2007, when this pie was entirely gray, so all of our earnings, all of our assets was for sale, so 100% sale. And today, you can see that the gray for sale assets has been reduced to 25%, while the investment asset has increased up to 75%. And as we continue to execute our transition plan, that number is going to go up. For investment asset will be 100% by 2015. Many developers develop commercial developments around China, but we are very narrowly focused, only in Beijing, only in Shanghai, and very much focused on office. So this, you can see that while SOHO China's asset of 1.7 million square meter is by far the #1 among these are all the publicly listed developers, including the Hong Kong developers, mainland developers. Our 1.7 million square meter portfolio is more than 3 times of the #2 and the #3. So it really shows you how dominant we are in this office market and how narrowly focused we are in this Beijing and Shanghai prime office space. You would ask, why only in Beijing? Why only in Shanghai? There's so many cities in China, and then this is a question that keeps on. I constantly get this question, and people keep on asking me, why are you so narrowly focused? Our view is this: that we have steered away from residential development for many years, which we believe that market has pretty much coming to an end. As you see that cities are very much urbanized, and residential developments are all over China, even down to the 3rd tier, 4th tier cities, the residential towers are everywhere. So we specifically moved away from that market for many, many years. But more importantly now, we constantly assess other 2nd tier cities or even other 1st tier cities. But again and again, we come back to Beijing and Shanghai. And I think this is the one that answers the question. First of all, if you take a look at this chart, you can see that Beijing's market size of prime office is 9.1 million square meter, while Shanghai is 5.6%. And the vacancy for these two markets are relatively low. Beijing only 3%, Shanghai less than 7%. And the rent is obviously much higher in these two markets than the others. And if you look at just Shenzhen and Guangzhou, for instance, the size of that market dropped lower than less than 50% of Shanghai market. And the vacancy is much higher. And when we know that, when your vacancy is much higher and your market size is so small, it means that the demand is not deep enough. It means that the market is not strong enough. It means that one or two more developments will just send the market up and down with a lot of uncertainty. And if you go down to even second-tier cities like Tianjin, Chengdu, and Chongqing, you will see that. Look at how small is Tianjin number. It's 0.6 million square meter, and Chongqing is the same. And Chengdu is 1.8 million square meters. So these are really a small fraction of Beijing and Shanghai office market. And the vacancy, look at Chengdu's vacancy, of course, is high, right? It's 44%. So half of those buildings already built are empty. And when your vacancy is that high, your rent, of course, is low. And on the other side is we look at the cost base. In real estate, the cost of China real estate, really the major cost is three parts. The land cost, construction cost, and also the tax. Tax and construction are pretty much the same nationwide. The difference is land cost. And even land cost for these cities, it's marginally different. If you want to buy a prime location Beijing office, the land may cost you 35,000 RMB. And that number is not much lower in Shenzhen, not that much lower in Tianjin. So your cost base is very marginally different, almost the same, but your rental is really very different. While Beijing can get 318 prime office rents, your Chongqing is less than 100, so less than a third. These are really the reason why we're so narrowly focused in Beijing and Shanghai. Now, if you look at the quarterly numbers for the rent, of course you will see ups and downs. But if you can, move beyond those quarterly numbers, you will see that the only way we will feel protected, the risk is being reasonably calculated, is to stay in the market where the demand is very deep. And the size market is quite sizable, and also the return to cost is reasonably high so that it will wither through the volatilities of the market.